In this week's update, is the bottom in place for gold? Another Goldilocks outcome for the US economy, and Bitcoin breaks $100,000. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information presented here is general information only. Your personal objectives, financial situation or needs have not been taken into account. Let's start with a market perspective. As we head rapidly into Christmas, more US economic data came out on Friday, and it was really a pretty much ideal combination of stronger payroll figures, big bounce back from the impact of the hurricane, but also unemployment was slightly higher. So there was a bit of each there to indicate that the labour market is still strong, but gives the Fed the justification to cut rates in December. And of course, whenever the Fed is going to cut rates, the market loves that. So it was pretty much the ideal formula. Now, if we look at the US market leaders, semiconductors are just going sideways at the moment. So there's a bit of a handbrake put on the enthusiasm around semiconductors, and it's related to this ongoing tech war with China that has a pretty pretty unpredictable outcome, because we never can be quite sure what Donald Trump is going to do. So I think that may continue into next year. Certainly in the US market, growth stocks are absolutely predominating over value or defensive stocks, and it's as stark as I've ever seen it. Is the market getting too enthusiastic? Is it getting too bubbly? Possibly, but that doesn't stop it going up even further. And underlining that is the fact that the defensive areas of staples and utilities were clearly the losers on the week, or the ones bringing up the rear. I think that the main comment that I would make about particularly the US market is that there are so many strong trends that it's easy to start to think, oh, they've run too far, too fast, and to start to get fearful that we're going to reach a peak. And when you look back in 6 months, you'll still find some stocks that are still running harder to the upside. So the message is, don't fear strong momentum, take advantage of strong momentum, ensure that you've got a good risk management plan in place, but it's much better to be riding momentum than it is trying to pick the bottoms. It's just not a high probability strategy. Now, as I say every week, it's far easier to lose money in the stock market than it is to win. And so you must make sure that you've got all of your required advices in place, investment, financial, legal, whatever they might be. It's most important, because investing and trading can be a very rewarding journey, but you've got to know how to do it properly. All right, let's have a look at the US market. American stocks, the S&P was up just under 1%, but the NASDAQ had a very strong week, up 3.5%, and particularly on Friday when we saw stocks like Amazon breaking out really robustly. Unusually, the Russell was down 1.2%, but I can tell you there are plenty of US small caps that are going up very, very powerfully. So that is such a broad index that figure is a bit misleading. You could have done incredibly well in US small caps in the last week. One of the most buoyant sectors over recent months has been travel. If you look at airline stocks, if you look at hotel stocks, wherever you look in the travel industry, the trends are strong and they're uninterrupted. They're amongst some of the strongest trends on the US market. So that is certainly a place to be paying attention to. The path of least resistance is to the upside for the US market as a whole. And that gets back to the point that I made previously about it's so much more effective to work with momentum rather than trying to pick turnarounds in oversold stocks. In this sort of market, stocks that are trending down and been trending down for a long period of time and are significantly oversold, when the sentiment is totally bullish, that's happening for a reason. So in trying to pick the bottoms in those stocks, you're pursuing a very low probability outcome, and that's just not a smart thing to do. The US dollar was steady, just under 106. The 10-year yield has now slipped. It wasn't down much during the last week, but it's certainly slipped about 0.3 over the last several weeks. So it's been quite a significant move to the downside. The VIX has also continued to work its way lower, and we're now down into the 12s. So let's go and look at the charts. There's the S&P on a weekly chart. So you can see with 4 of the last 5 weeks have been very strong to the upside. And if you look a little bit further, then there's only been 3 negative weeks in about the last 12 or 14 weeks. So it's been a very, very powerful trend, and that's where the momentum is. So, don't argue with it. That's what the market is telling us. There's the Russell 2000. So we were up at this major double top. The market pulled back from that. But if you look at the trend, this is a weekly chart. So if you look at the trend, since this breakout, let's say at the start of August, then it's quite a decent move to the upside. So small caps are still doing pretty well. NASDAQ also, you can see there on a weekly chart, had a very good week and finished right on its highs. Semiconductors just stuck in the middle, really. And I think it's all the uncertainty over how this tech war is going to play out. If we look at the charts on a sector basis, this is over the last quarter. XLY, which is consumer discretionary, absolutely killing it. Big contributions from Amazon and Tesla, of course, that dominate that index. But there are a lot of other consumer discretionary stocks that are doing well. Following them, we've got communication services and technology, and they certainly had a pretty good week. Finance has just cooled off a little bit. Big surge after the election, with the almost certainty that Trump will wind back regulations that will make it more profitable for financial firms. But just in the last week, it had maybe got a little bit too far. We'd say we saw a bit of an easing in finance stocks. Energy, again, had a poor week. So did materials and consumer staples and healthcare, still hanging around the bottom. The healthcare sector is one that I thought would have done a little bit better, but not to be. Turning to the Australian market now, information technology leading the way with so many strong performers in that index. Small caps doing better than many parts of the Australian market. Materials, again, also have really been off the boil since around the end of September. So the last couple of months have been a real struggle for materials. Finance picked up, but eased off a bit in the last week. And again, healthcare and energy, very interesting at the bottom of the pack in the Australian market. So looking very similar. If we just check in on the currencies, there's DXY, the US dollar index, not much change there across the week, but the Australian dollar was actually quite weak and fell by far more than the US dollar moved. So that's the currency situation. So just to summarize, 63.25 is where we finished on the Aussie dollar. Our index was down 16 points, not much, only 0.2% for the week, but it was a very negative sentiment finish. Friday was a pretty sad day. Whether the market was just apprehensive about the US economic data, because the Australian market does get used to a degree as a hedge to front-run exposure before the US market opened. So it's possible that there was a bit of that playing into it, that the Australian market was being hedged against potentially a fall in the US market. Anyway, it doesn't really matter what the cause was. The sentiment was pretty negative, and our market is lagging at the index level, is lagging the US market very significantly. But again, as with America, there are just so many small caps that have got excellent upward momentum. So, just do that. Don't try and do anything else more creative. Precious metals, gold lost a little bit, down $21 or 0.8%. If we translate that to Australian dollars, with our lower dollar, 4137. So it's extremely profitable territory. And I say it every week, but the Australian gold miners really should be doing, price-wise, should be doing a lot better than they are. I think the market is very concerned about the cost structure of Australian miners. But even with that, the margins they must be making certainly warrant higher prices. And we're coming from a point where gold stocks are lagging on a long-term situation compared to the gold price. and the gold price is trending up, gold stocks should be doing a heck of a lot better than they are. And at some stage they will. It's very hard to know when that's going to be. Silver was also higher to 31.3, as we'll see. But the gold market is really stuck in a pretty tight range. We saw for the first time in 6 months, we saw outflows from gold ETFs, and that corresponded to a lesser buying from China. Whether that is just a one-off, I'd suggest it probably is. It's hard to see China reversing the long-term policy they've had to accumulate gold reserves. So for gold at the moment, I think it's about a 50-50 bet on whether we've seen the lows or not. So let's just take a look at that chart. So there's the gold price in US dollars. And if we step back and look at the big picture, there's no question, undoubtedly, this is a very, very strong uptrend. And over the last 4 or 5 weeks, we've been getting a consolidation. Nothing unusual about that. We move up, we consolidate, we move up, and we've got another consolidation period. But the question is this the bottom here, or are we looking at perhaps 25.30, 24.75, or perhaps even 24.30 as the bottom of that consolidation? And the answer is I really have no idea. I'm just going to play it as it comes. I actually don't want to have an opinion about that. But the undoubted observation is that this is a very powerful uptrend on a weekly basis. And if we put it on a daily chart, we're getting a little bit of a rollover of the 50-day moving average in the last couple of weeks. But that's just all part of the consolidation. That happened back here when you go into a consolidation mode. The shorter term moving averages do turn over. If I put a 150 on that, a 200 on that, then you can see there's really been no impact on the longer term moving averages. Aussie dollars, that's very, very strong. And if we look at silver, then we've got the market still holding this important $30 support level. So I think while that $30 support level holds, silver's still in reasonably good shape. So I think the longer term outlook, whether that's 3 months, 6 months, 2 years, the longer term outlook is very, very positive. So I think there is certainly a place in portfolios for precious metals. But again, have a clear plan around how you're going to do that. When we look at gold stocks, the big picture, as I said, we're grossly undervalued relative to gold. And at some stage, there will be the leverage response that you typically see in bull market cycles, where gold stocks will increase at a rate of 3 to 4 to 5 times that of gold. But we're certainly not there at this point in time. Now, looking at Bitcoin, which I've started including a bit lately because it's pretty hard to deny what is going on in the Bitcoin market. So we'll have a look at that chart in just a minute. The latest number as of this morning was just $50 under the $100,000 mark. In Aussie dollars, 156,400. So that's a very, very buoyant price. If we look at the future for Bitcoin, and I've been upfront that I've been a Bitcoin skeptic. I've been shifting my acceptance over the last year or two, but it was an asset class that I just couldn't get my head around, didn't make enough sense to me. But increasingly, there are actions around creating a structured regulatory environment, which makes it a more acceptable, investable class. We've now got the support of Trump and his administration, and he's just made a Securities Commission appointment that will be very friendly towards cryptocurrencies. So these things are all providing huge positives for the continued momentum of Bitcoin. Now, for those that struggle with the concept of Bitcoin, and I've by no means become an evangelist, but I've certainly had to move to the point now where I've got to think about Bitcoin this way. I was always concerned that where would the sustained long-term demand come from? I needed to see institutions join the party. I needed to see governments become far more favourable towards currencies. So if you're still struggling with the concept, just think about this. Forget that it's Bitcoin or cryptocurrency. Just think about it as an investing class where you've got capped supply. We'll reach a point, and mining of new Bitcoin is slowing rapidly. So we'll reach a point where there'll be no new Bitcoin created. So think of an asset class where the supply is absolutely capped. The question in my mind was, what would happen to demand? Well, I think it's now very clear that we've got rising demand. And with everything that's going on around the world with these extreme, you could even call them obscene debt levels, there's every chance now that demand will keep rising. So if you've got capped supply, you've got rising demand, and we've got a chart pattern that's incredibly compelling now. I just don't think Bitcoin is an area that can be ignored anymore. So let's go and look at that chart because it's very, very positive. There we go. So that's the Bitcoin chart. On a daily, you can see we have a lengthy consolidation that ran between March of 2024 and just recently. So basically straight after the US election. And we moved in the band between 54,000 and around 73, 74,000. So that was the band. With the US election, we've now burst out of that band. So it's provided enough additional buying power to really push this up. And we exceeded 100,000 on Thursday and then exceeded 100,000 again on Friday, got to 102, but closed just a touch underneath. So just to summarize again, it's obvious now that Bitcoin is not going away and cryptocurrencies are not going away. It's too widely accepted. I feel much more comfortable that this can be considered a hedge against monetary policy. But cryptocurrencies themselves do bother me because of the security issues. So why not ETFs? It removes all the hassle. And as I mentioned last week, MSTR, that should read, was certainly worth a look. So that's Bitcoin. It's a market that's certainly got the tongues wagging again. Turning to other commodities now, copper was up slightly, about 10 cents, up to 4.14, nickel at 7.15. The copper majors, the outlook hasn't changed. The copper majors still remain highly bullish. They're expanding production. They're positioning themselves for a very buoyant market in the last couple of years of this decade. So the long-term outlook is still very good, but copper stocks are struggling. They're saying something completely different to what the majors are doing. Again, at some point, as with gold stocks, that will change. We just don't know the when. Now, crude oil eased again a little bit, down to 67.2. There are now some supply fears, so OPEC Plus not staying in agreement about production levels, so a bit of a fear around supply. There's also some concern around weak global demand outlook as well, so that is weighing on crude oil. And 65 remains the key support level for West Texas Intermediate. Uranium is worth a look this week as well. There are very, very large divergences on the chart, which I find inexplicable, so I won't even try. And I'll show you a chart of US uranium stocks versus the local uranium stocks. In fact, let's do that right now. So this is Cameco, the Western world's biggest producer, behind Kazakhstan. So this is the price chart on a weekly basis. You can see there is a very strong long-term uptrend that started in 2020. We had a huge dip in the middle of the year here, but we've certainly regained very, very sharp momentum. And that obviously will feed into URA as well, being the largest individual stock producer. Then URA is going to look quite similar, which it does, perhaps not quite as pronounced an uptrend, but nevertheless, global uranium stocks are in uptrend. But then we come to the Australian market, and those trends are really consistent with what you'd expect from the fundamentals. The fundamental outlook for uranium looks very, very positive. This is Paladin, so I'll just highlight a couple of the Australian producer developers. So this is Paladin that's been in strong downtrend since May, and that looks really crook. And Boss Energy, not a whole lot better. So, as I said, I have no explanation for why there's such a big divergence, but I just observe that it is, and that Australian uranium stocks are heading rapidly to the downside, and so there's a fair amount of danger in that sector of the market. Hard to understand. Last week I said that tactically, or perhaps it was a couple of weeks ago, tactically that tight stop losses might be a good idea because of the way that the Australian uranium stocks were looking. So hopefully, if you had exposure to that sector, you took note of that recommendation. So wrapping it up, final thoughts now, just turning my mind to what 2025 might look like based on the balance of probabilities. So not a prediction, because they're worse than useless, but just where the balance of probabilities lie. There is so much momentum in the market, in so many parts of the market, that there's no reason why the index trends can't continue to the upside. However, to expect them just to keep going up and up and up all the time is completely unrealistic. And prices are stretched. So expect some sharp volatility. Whether we see it in December or January or February, I would like to bet that by early February at the absolute latest, and again, this is just based on decades of observing the market, when it comes into the end of the year with this amount of strength, we see weakness in January and or February, and it can sometimes be very sharp. So I think it's likely that we're going to see something similar in the next few months. It remains very much an individual stock picker's market, so it's important to be good at that. If you're an independent trader and investor, just get good at identifying the sort of stocks that are going to gain the support of the market. So it's partially about good fundamentals, but it's also partially about having the sentiment favor of the market as well. Because there's plenty of stocks that have got great fundamentals and offer terrific value. The market just is not interested. And small cap copper developers is just but one but many that you could point to. Okay, more when we get into the new year. Portfolio analysts coming this week. There's an interesting question I'm going to address, and it's the process for transitioning one's portfolio from where you don't want it to be, where it's underperforming, to a much better place, to where you want your portfolio to end up. So I think that will be a very interesting session. That's it for this week. There's more information on the website, and there's my email address, and I will be back with you shortly. Cheers.